When you meet a financial advisor, they show growth charts. What they rarely show is the chart of lost wealth. Today, we'll audit the average portfolio to reveal how hidden fees quietly drain retirement savings. If you want to keep more of your money instead of handing it over to Wall Street, hit subscribe and turn on notifications. Let's dive in. Section 1. The Maria Case Study, the Silent Drain. Let's look at a real-world scenario. Maria, age 26, invests $500 a month through an advisor. After 20 years, she has $287,000, more than doubling her $120,000 contribution. But then she runs the numbers against a benchmark. If she had invested that same money in a low-cost S&P 500 index fund, she would have roughly $392,000. Where did the missing $105,000 go? It vanished into the fee trap. Advisor fee, 1%. AUM, assets under management. Fund expense ratios, 0.8%. The average for actively managed funds. Administrative costs, 0.1%. Total annual fee, 1.9%. To Maria, 1.9% sounded like pennies, but over 20 years, that 1.9% compounded. It didn't just take a slice of the pie, it prevented the pie from growing. She lost the fee plus the growth on that fee. Section 2. The Small Number Psychological Trick. The financial industry is brilliant at marketing. They know that if they sent you a bill for $5,000 a year, you would cancel the service immediately. So they don't send a bill. They deduct a percentage. They say, we only charge 1%. Your brain thinks, 1% is nothing. I get to keep 99%. This is mathematically false. You are not paying 1% of your gains, you are paying 1% of your total assets every year. The 25% of harvest analogy. Imagine you are a farmer. You buy the seeds, you till the land, you water the crops, you take the risk of drought. At harvest time, a guy in a suit shows up and takes 25 to 33% of your crop. Framed as 1%, it feels small. In reality, it's a third of your harvest. Section 3. The Layers of Extraction, Hidden Fees. Advisor fees are just the tip of the iceberg. Beneath the surface, there are layers of costs that are intentionally opaque. Expense ratios. The average actively managed mutual fund charges 0.44 to 1.0%. A passive ETF might charge 0.03%. 12B1 fees. These are marketing fees. You're literally paying the mutual fund company to advertise itself. They add no value to your returns. Front-end loads. Some funds charge you 5% just to buy the fund. You invest $100 and only $95 goes to work. This practice is outdated in 2026, yet it still exists. Trading costs and turnover. Active managers trade stocks frequently. Every trade generates transaction costs and potential capital gains taxes, which drag down your net return. When you stack these up, the 1% fee is often actually 2 to 2.5% all in. If this analysis is making you rethink your portfolio, please hit that like button. It helps us spread this crucial financial literacy to more investors. Section 4. The Performance Myth, SPIVA Scorecard. You might say, but I don't mind paying fees if my advisor beats the market. That is the great tragedy. They usually don't. SPIVA data shows 85 to 90% of large-cap managers underperform the S&P 500 over 15 years. Investors pay premium fees for results that lag simple index strategies. Section 5. The $1,000,000 Math, the 40-year cost. Let's run the numbers for a serious investor to see the true damage. Scenario: you contribute $1,000 a month for 40 years. Market return, 8%, gross. Investor A, the indexer. Fees, 0.05%. Low-cost ETFs. Net return, 7.95%. Ending balance, $3.3 million. Investor B, the advisory client. Fees, 2%, advisor plus fund fees. Net return, 6%. Ending balance, $1.9 million. The difference? $1.4 million. Investor B paid $1.4 million for advice. Did the advisor provide $1.4 million worth of value? Did they make you $1.4 million happier? Section 6. The ETF solution. How to opt out. So, how do you escape the trap? You have to simplify. The financial industry dislikes ETFs and index funds because they are bad for their business model but excellent for yours. Vanguard S&P 500 (VOO) expense ratio is 0.03%. That is $3 per year for every $10,000 invested. Fidelity Total Market FSKAX expense ratio is 0.015%. By switching to a self-managed portfolio of low-cost index funds, you essentially give yourself a 2% raise on your capital every single year. You don't need a degree in finance, you just need to buy the whole market and hold it. Section 7. When is an advisor worth it? To be fair, financial advisors are not the problem, the fee model is. There are times when paying for advice is worth it. Complex tax situations. If you have business equity, real estate, or inheritance issues. Behavioral coaching. If you panic sell every time the market drops 10%, an advisor who stops you is worth their weight in gold. Estate planning. Setting up trusts and wills. The solution: pay a flat fee or hourly rate like hiring a lawyer rather than a percentage of your assets forever. Section 8. The audit. Your homework. Here is what you need to do tonight. Log into your investment account. Check expense ratios. If above 0.5, you're likely overpaying. Look for advisory or management fees. Run the math. What does that fee cost this year and in 20 years? Knowledge is leverage. Once you see the number, you cannot unsee it. The 1% fee is not a small leak, it is a hole in the bottom of your boat. Check your expense ratios. Aim for under 0.1%. Consider moving away from high-fee advisors. Switch to flat-fee models. Buy index funds. Match or outperform most active managers. Protect your compound interest. It belongs to you. The financial industry relies on your apathy. Don't give it to them. I'm curious to hear from you. Have you ever checked your 401k fees? What is the highest expense ratio you found? Do you use a financial advisor? Do you feel you get value for the percentage you pay? Drop your answers in the comments and subscribe for more educational content on personal finance. Thanks for watching.